Good day everyone, we're Group 5 and today we're about to discuss the cash flow statements. And for the outline, introduction, next, components and formats of the cash flow statements, followed by the cash flow statement linkages and preparation, and lastly, the cash flow statement analysis.
Hi everyone, I am Jeline Malyari and I am in charge in giving you a short introduction about our topic, which is the cash flow statement. In financial accounting, a cash flow statement, also known as statement of cash flows or funds flow statement, is a financial statement that shows how changes in balance sheet accounts and income affect cash and cash equivalents. It also breaks the analysis down to operating, investing, and financing activities. Essentially, the cash flow statement is concerned with the flow of cash in and out of the business. The statement captures both the current operating results and the accompanying changes in the balance sheet and income statement. These are the people and groups interested in cash flow statement. Number 1, accounting personnel who need to know whether the organization will be able to cover payroll and other immediate expenses. Number 2, potential lenders or creditors who want a clear picture of a company's ability to repay. Number 3, potential investors who need to judge whether the company is financially sound. Number 4, potential employees or contractors who need to know whether the company will be able to afford compensation. And lastly, shareholders of the business. After giving you a short introduction about cash flow statement, let me give you a simple discussion about the components of cash flow statement. The cash flow statement is partitioned into three segments: cash flow resulting from operating activities, cash flow resulting from investing activities, and cash flow resulting from financing activities. Operating activities refers to the amount of cash a company generates from the revenues it brings in, excluding costs associated with long-term investment on capital items or investment in securities. Operating activities include the production, sales, and delivery of company's product as well as collecting payments from its customers. This could include purchasing raw materials, building inventory, advertising, and shipping the product. Cash flow from investing activities involves long-term uses of cash. The purchase or sale of a fixed asset like property, plant, or equipment would be an investing activity. Also, proceeds from the sale of a division or cash out as a result of a merger or acquisition would fall under investing activities. Any changes in cash positions of a company that involves assets, investments, or equipment would be listed under investing activities. Cash flow from financing activities arise from borrowing, repaying, or raising of money. Financing activities include the inflow of cash from investors, such as banks and shareholders, and the outflow of cash to shareholders as dividends as the company generates income. Other activities that impact the long-term liabilities and equity of the company are also listed in the financing activities section of the cash flow statement. For better understanding about the components of cash flow statement, one of my groupmates will explain it in more detailed manner.
Hi, good afternoon. I am Christine Joyce Guillermo, and for today, I am going to discuss the classification of cash flows and non-cash flows activities. As you can see, the consolidated statement of cash flows is organized into three distinct sections: the operating activities, investing activities, and financing activities. Operating activities are the functions of a business directly related to providing its goods and or services to the market. It is also the daily activities of a company involving producing and selling its product, generating revenues, as well as general administrative and maintenance activities. Yung operating activities, classification siya ng cash flows within the statement of cash flows. Lahat ng mga bagay na ginagawa ng isang company or business to bring its product and services to market on an ongoing basis. Yung cash flows from operating activities, nag-act siya as a financial parameter for analysts and investors para ma-determine yung functionality ng isang company. Tinutukoy nito ang kakayahan ng isang business na barayan yung current expenses like labor wages, administrative expenses, and so on. Yung operating activities, siya yung kinukonsidered as the most important section because it provides cash flow information related to the daily operations ng isang business and allows stakeholders para po makita yung viability ng isang business. Operating activities for a company include manufacturing, which means creation of new products either from raw materials or components, sales and revenue. Magkaiba po yung sales sa revenue. Sales po is income generated by a company from selling their goods and services to their customers, while yung revenue naman po is the income generated by a company before subtracting any expenses from the total. Yung revenue is greater than sales because revenue is the money you make from sales. Taxes, which is ito yung mandatory contributions collected by governments, advertising and marketing activities, which refers to costs incurred in promoting business such as publications, flyers, billboards, and so on. Cash flow from operating activities is the first section depicted on a cash flow statement, which also includes cash from investing and financing activities. There are two methods for depicting cash from operating activities on a cash flow statement, the indirect method and the direct method. I-report po ito mamaya ng isa sa mga kagroup ko. Investing activities is one of the sections on the cash flow statement that reports how much cash has been generated or spent from various investment-related activities in a specific period. Dito naman sa investing activities, nagpo-provide po ng account of cash na ginamit sa pag-purchase ng mga non-current assets or long-term assets such as property and equipment that are intended to produce a profit in the future. Buying and selling long-term assets and other business investment is an example of investment activity. Dito sa investing activity, kunwari, gustong malaman ng mga investors and analysts kung magkano yung ginugol or ginugugol ng isang company sa properties, plant, and equipment, they can look for the sources and uses of fund in investing sections of the cash flow statement. Cash flow from investing activities is an important aspect of growth and capital because it shows how a company is allocating from the long term. Investment activities are essential in supporting future business growth. By investing, companies expect to get more revenue and make higher profits. Investing activities include purchase of long-term assets such as property, plant, and equipment, acquisitions of other business, and investment in marketable securities such as stocks and bonds. There are three types of investing activities: stock, bonds, and cash equivalents. Stocks is a type of investment that represent an ownership share in a company. Investors buy stocks that they think will go up in value over time. Yung stocks represent the partial ownership or equity in a company. For example, kapag bumili ka ng shares of stocks, you're actually purchasing a tiny slice of the company. The more shares you buy, the more the company you own. There are two main types of stocks: common stocks and preferred stocks. The difference between the two is common stockholders have the right to receive dividends and votes in shareholder meetings, while preferred shareholders have limited or no voting rights. Bonds, also known as fixed income instruments, are used by governments or companies to raise money by borrowing from investors. Bonds are typically issued to raise funds for specific projects. The three major types of bonds are corporate, municipal, and treasury bonds. Corporate bonds are debt instruments issued by a company to raise capital for initiatives like expansion, research, and development. The interest you earn from corporate bonds is taxable, but corporate bonds usually offer higher yields than government or municipal bonds to offset this disadvantage. Municipal bonds are issued by a city, town, or state to raise money for public projects such as schools, roads, and hospitals. Unlike corporate bonds, the interest you earn from municipal bonds is tax-free. There are two types of municipal bonds: general obligation and revenue. Treasury bonds, also known as T-bonds, are issued by the U.S. government. Since they are backed by the full faith and credit of the U.S. government. Treasury bonds are considered risk-free. But treasury bonds don't yield interest rates as high as corporate bonds, while treasury bonds are subject to related to federal tax. They are exempted from state and local taxes. And yung last type of investing activities is cash equivalents. Cash equivalents are the total value of cash on hand that include items that are like cash. Cash and cash equivalents must be current assets. Analysts can also estimate whether it is good to invest in a particular company through its ability to generate cash and cash equivalents, since it reflects how a company is able to pay its bill throughout a short period of time. There are five types of cash equivalents: treasury bills, commercial paper, marketable securities, money market funds, and short-term government bonds. Financing activities refer to the flow of cash between a business and its owners and creditors. It focuses on how the business raises capital and pay back its investors. The activities include issuing and selling stock, paying cash dividends, and adding loans. Dito naman po, section siya ng company's cash flow statement, which is pinapakita niya yung net flow of cash na ginamit sa pag-fund ng company. Pinapakita yung state ng financial health ng isang company. Financing activities provide investors with insight into a company's financial strength and how well a company's capital structure is managed. Financial activities is one of the important items on the statement of cash flows because it can represent a substantial source or use of cash that significantly offsets any positive or negative amounts of cash flow generated from operations. Non-cash flows activities. These non-cash activities may include depreciation and amortization as well as obsolescence. Property, plant, and equipment resides on the balance sheet. These items are taken on the income statement in small increments called depreciation or amortization. Amortization po is the practice of spreading an intangible assets cost over that asset's useful life. Example of intangible assets that are expensed through amortization are patents, trademarks, and copyrights. While yung depreciation naman po is the expensing of a fixed assets over its useful life. Fixed assets are tangible assets, meaning they are physical assets that can be touched. Example of fixed or tangible assets that are commonly depreciated include building, equipment, furnitures, land, machinery, and vehicles. Yung obsolescence naman is referred as the state of becoming obsolete. Kunwari, yung inventory or any business asset, nagiging obsolete siya kapag yung item is hindi na saleable or useful. Loss in value of an asset due to loss of usefulness or technological factors. There are three types of non-cash activities: non-cash operating activities, non-cash investing activities, and non-cash financing activities. Non-cash operating activities are one-time events that may affect revenues, expenses, or cash flow but fall outside of a company's routine core business. It is comprised of cash inflows and outflows that are not related to a company's day-to-day business operations. Dito naman sa non-cash operating activities, hindi ito related sa araw-araw na business operations ng isang company. Sabi nga, one-time event na maaring makaapekto sa revenues and expenses ng isang company. Kunwari, nagkabagyo, nasira yung buildings or yung mga machine and equipment, syempre, ipapagawa pa nila yung mga yon, which is magkukos ng gastos at maaapektuhan ang revenue ng isang company. Dahil nga, imbis na magtuloy-tuloy yung operation ng business, mauudlot pa. Kailangan pa nilang ipagawa or bumili ng bago at imbis na masisave na nila yung money or makakount as a revenue, ay magagastos pa. Examples of non-operating cash flow can include taking out a loan, issuing new stock, and the self-tender defense, among many others. Items listed under non-operating cash flows are usually non-recurring. Non-cash investing activities and non-cash financing activities. Some investing and financing activities occur without generating or consuming cash. Non-cash investing and financing activities may be much important for the users of financial statements because they may have a significant impact on the current and future performance in terms of revenues, profits, and the ability of the entity to generate positive cash flows. Dito naman sa non-investing and financing activities, it happens nang hindi ka nag-generate or nagko-consume ng cash. Hindi po siya nare-report sa cash flow statement since wala nga ang cash na involved. Halimbawa, ang isang company ay pwedeng makipagpalitan ng common stock para sa lupa or mag-acquire ng isang building kapalit ng notes payable. While these transactions do not entail a direct inflow or outflow of cash, they do pertain to significant investing and or financing activities.
Good day, future executives. I'm Darren Arceo, and today I will discuss to you a summary of differences between IFRS and the US GAAP. Before I start to the main topic, let me share to you an overview of US GAAP and the IFRS. The standards that govern financial reporting and accounting vary from country to country. In the United States, financial reporting practices are set forth by the Financial Accounting Standard Board or the FASB and organized within the framework of the accepted accounting principles. IFRS are issued by the International Accounting Standards Board or the IASB, and they specify exactly how accountants must maintain and report their accounts. Next, GAAP versus IFRS. These two accounting principles is the most debatable topic in accounting. They have both set of standards that is sufficient for business owners and account professionals to know more about variations and nature of business accountancy in order to successfully manage your company locally, even globally. Also, yung dalawang accounting principle na ito ay kino-consider na most widely accepted accounting standard na ginagamit ng mga businesses internationally. Now, let's define IFRS. International Financial Reporting Standards, also known as IFRS, are a set of international accounting standards which state how particular types of transactions and other events should be reported in financial statements. Ang IFRS ay under sa tinatawag na IASB or the International Accounting Standard Board. Ang layunin ng accounting standard na ito ay mailagay or mai-record ng mga accountants ang kanilang financial report ng mas malinaw at sa paraang madaling maintindihan ng iba. Ito ay itinatag upang magkaroon ng iisa or magkakaparehong accounting language. So yung mga businesses at saka yung mga accounts ay mas maintindihan from company to company and country to country. Let's move on to the US GAAP. Generally Accepted Accounting Principles, also known as GAAP, refers to a common set of accepted accounting principles, standards, and procedures that companies and their accountants must follow when they compile their financial statements. GAAP also addresses such things as revenue recognition, balance sheet, item classification, and outstanding share measurements. The main goal of GAAP is to ensure that financial reporting is transparent and consistent from one organization to another. Ang rule ng GAAP, kapag ang isang kumpanya ay gumamit ng financial statement outside sa kanyang premises, yung GAAP dapat yung kanyang fina-follow. The primary difference between the two systems is that GAAP is rule-based and IFRS is principle-based. Rule-based focuses more on specific rules and research, while the other is based more on broad principles, whereas it looks at the overall patterns. This disconnect manifests itself in specific details in interpretations, which is yun yung GAAP. While sa IFRS naman, ito yung mga guidelines provides less detail. Basically, IFRS need more interpretation and disclosures when it comes to financial statements. So, in summary, mas madali or mas specific ang GAAP kaysa dun sa IFRS na mas nangangailangan pa ng more interpretation sa pagintindi ng kanilang financial statement. There is also key differences between IFRS and the US GAAP. Number 1, adoption. IFRS is a globally adopted method for accounting, while GAAP is exclusively used within the United States. IFRS is used in more than 110 countries around the world, like Philippines, Russia, South Korea, Singapore, and other Asian and South American countries. So, in summary, mas madami ang gumagamit ng IFRS na accounting standard kesa dun sa GAAP na nagstay lang siya within the border of United States. Number two differences is the inventory methods. The most notable specific difference between GAAP and IFRS involves their treatment of inventory. IFRS rules ban the use of last in, first out or LIFO inventory accounting methods. In GAAP, rules allows for LIFO. Both systems allows for the first in, first out method or the FIFO and the weighted average cost method. So, yung FIFO assumes that the first unit making its way to inventory or the oldest inventory is sold first. Unlike dun sa last in, first out, assumes that the last unit to arrive in inventory is sold first. Next, income statement. Extraordinary or unusual items are included in the income statements and not segregated under IFRS, while under GAAP, they are separated and shown below the net income portion of the income statements. In GAAP, interest and dividend income and interest expense are reported in the operating section of an indirect method cash flow statements as part of the net income. Yung treatment naman ng income statement using IFRS ay magkaiba. Reported in investing section of the cash flow statement yung interest and dividend income, while yung interest expense naman ay reported siya under financing section ng cash flow statements. In summary, interest and dividend income and interest expense under operating income using the US GAAP. Unlike sa IFRS na magkahiwalay ang dalawa. Under investing and financing cash flow statements ang interest expense at saka yung interest and dividend income. Next, fixed assets. In fixed assets, companies using GAAP accounting must value these assets using the cost model. IFRS uses a different model for fixed assets called the revaluation model. So, the key differences between the two models is that the value of non-current assets are valued on the price spent to require the asset under cost model, while assets are shown at fair value under revaluation model. And both models specified in IAS 16, which is the property, plant, and equipment that businesses can utilize to remeasure non-current assets. Another difference is intangible assets. When it comes to intangible assets, IFRS takes into account whether an asset will have a future economic benefits as a way of amending the value. Intangible assets measured under GAAP are recognized at the fair market value and nothing more. In GAAP, intangible assets are valued at fair value. It is the estimated worth ng company's asset and liabilities na nakatala sa financial statement ng isang company. In IFRS naman, dito naman yung intangible assets are valued on the basis of future economic benefits. Future economic benefits can be described as the scarce capacity to provide benefits to the entities that use them, and it is the potential or ability to contribute directly or indirectly to the flow of cash and cash equivalents. We also have development cost. In IFRS, some development costs are expensed and other are capitalized and amortized, or nakakapitalize ang mga accounts kapag na-meet ang certain criteria. Unless dun sa GAAP na lahat ng development costs are expensed out. The last differences between the two accounting standards is the quality characteristics. The qualitative characteristics to how the accounting method functions. GAAP makes intelligent decisions based on user-specific conditions using a hierarchy of attributes such as relevance, comparability, and understandability. IFRS has the same properties as GAAP, but with the distinction that judgments cannot be based on an individual's personal circumstances. So, lahat ng mga nabanggit na differences na ito ay mahalaga na malaman ng isang company or businesses or ng mga accountants para makapag-transact sila or makagawa sila ng transaction ng businesses internationally. I have here key takeaways that summarizes my report about IFRS and the US GAAP. So, para mas madali nating maintindihan at matandaan ang pagkakaiba ng dalawang accounting standard na ito. GAAP is a common set of accepted accounting principles, standards, and procedures that companies and their accountants must follow when they compile their financial statements. IFRS naman is a set of international accounting standards which state how particular types of transactions and other events should be prepared in financial statements. Some accountants consider methodology to be the primary differences between the two systems. And yun nga yung GAAP is a rule-based and IFRS is a principle-based. Both IFRS and US GAAP provide economic events to financial reports, as well as concepts, regulations, and advice for bookkeeping journal entries and financial statement preparation. That's all about my report. Now, let's hear from the next presenter. Thank you.
Good day, everyone. I am Narisa Kabilangan and I will be talking about direct and indirect methods for reporting cash flows from operating activities. The cash flow statement contains three sets of activities, namely operating, investing, and financing. And usually, the investing and financing sections are calculated similarly. But when it comes to calculating cash flow from operational activity, two methods of calculation are majorly used, and these are direct and indirect method. Direct and indirect are two different methods used for the preparation of the cash flow statement of the companies, with the main difference relates to the cash flows from operating activities. Where in case of direct cash flow method, it changes in the cash receipts and the cash payments are reported in cash flows from the operating activities section. Whereas in case of the indirect cash flow method, changes in assets and liabilities accounts is adjusted in the net income to arrive cash flows from the operating activities. To better understand the two methods, let's elaborate each one of them. First is the direct method. The direct method is one of the two accounting treatments used to generate a cash flow statement. A cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operations and external investment sources. It also includes all cash outflows that pay for business activities and investment during a given period. The statement of cash flows direct method uses actual cash inflows and outflows from the company's operations instead of modifying the operating section from accrual accounting to a cash basis. Accrual accounting is an accounting method where revenue or expenses are recorded when a transaction occurs rather than when payment is received or made. In other words, the direct method for the statement of cash flows provides more detail about the operating cash flow accounts, although it is time consuming. The cash flow direct method measures only the cash that's been received, which is typically from customers, and the cash payments or outflows such as to suppliers. The inflows and outflows are netted to arrive at the cash flow. The direct method is also known as the income statement method, where the direct method lists the cash receipts and the cash payments made during the accounting period. The cash outflows are subtracted from the cash inflows to calculate the net cash flow from operating activities, before the net cash from investing and financing activities are included to get the net cash increase or decrease in the company for that period of time. The difficulty and time required to list all the cash disbursements and receipts required for the direct method makes the indirect method a preferred and more commonly used practice. Since most companies use the accrual method of accounting, business activities are recorded on the balance sheet and income statement consistent with this method. A straightforward presentation of the cash flow from operations section using the direct method looks somewhat like this. Listing out information this way provides the financial statement user with a more detailed view of where a company's cash came from, how it was disbursed. For this reason, the Financial Accounting Standards Board recommends companies use the direct method, although it has its disadvantages. The statement of cash flows direct method reports the direct sources of cash receipts and payments, which can be helpful to investors and creditors. Next method is the indirect method. The indirect method is one of the two accounting treatments used to generate the cash flow statement. The indirect method uses increases and decreases in balance sheet line items to modify the operating section of the cash flow statement from the accrual method and to the cash method of accounting. Cash accounting is an accounting method where payment receipts are reported during the period in which they are received and the expenses are recorded in the period in which they are actually paid. In other words, revenues and expenses are recorded when cash is received and paid, respectively. Under the indirect method, the cash flow statement begins with net income on an accrual basis and subsequently adds and subtracts non-cash item to reconcile to actual cash flow from operations. The indirect method is often easier to use than the direct method since most larger businesses already use accrual accounting. The complexity and time required to list every cash disbursement, as required by the direct method, makes the indirect method preferred and more commonly used. A presentation of the cash flow from operations section using the indirect method looks somewhat like this. The indirect method presents the statement of cash flows beginning with net income or loss, with subsequent additions or deductions from that amount for non-cash revenue and expense items, resulting in cash flow from operating activities. Many accountants favor the indirect technique since it is easier to generate the cash flow statement using data from the income statement and balance sheet. Because most businesses employ the accrual method of accounting, the income statement and balance sheet will reflect these values. And to better understand direct and indirect method, here are their key differences. First, about their definition. Indirect method uses net income as a base and adds non-cash expenses like depreciation, deducts non-cash income like profit on sales scraps, and net adjustment between current assets and liabilities to produce the overall cash flow statement. While the cash flow direct method uses only the cash transactions, example are cash spent and cash received to produce the cash flow statement. Second is how they work. Cash flow in direct method, net income is automatically converted in the form of cash flow, while in the cash flow direct method, reconciliation is done to separate the cash flow from the others. Last is about their accuracy. Indirect method is not very accurate as adjustments are being made, while direct method is very accurate as there is no need for any adjustments.